You might not realize it, but every time the Federal Reserve raises interest rates, your wallet feels it, sometimes in ways you don't even notice. Maybe your credit card bill is a little higher, or your mortgage payment just crept up. Inflation feels like it's running wild, and suddenly, everyday expenses start adding up faster than you thought. In this video, we'll uncover the hidden ways Fed rate hikes affect your money, explain why it matters to every American, and share tips to protect yourself in these uncertain times. Before we dive in, if you want to stay ahead of your finances and make smarter money moves in 2025, hit that like button and subscribe to AI Cash Cortex right now. We break down complex financial topics with AI-powered insights, so you never miss what matters to your wallet. Let's start with the basics. What is the Federal Reserve, or the Fed, and why do their decisions on interest rates matter so much to you? The Fed is the central bank of the United States. Think of it as the country's financial thermostat. When the economy gets too hot, like inflation rising too fast, the Fed raises interest rates to cool things down. When the economy slows, they lower rates to encourage borrowing and spending. But how does this thermostat affect your everyday life? Well, higher interest rates mean borrowing money gets more expensive for you, for businesses, and for the government. That means your loans, credit cards, and even mortgages can cost more. On the flip side, higher rates can mean better returns on savings accounts and CDs, but usually it's a slow process. So understanding how the Fed's rate changes ripple through the economy is key to making smarter financial decisions. Now that we know what the Fed does, let's talk about how rate hikes hit your wallet directly, starting with loans and credit cards. Many Americans carry balances on credit cards, home equity lines of credit, HELOCs, or have adjustable rate mortgages. These loans usually have variable interest rates, meaning when the Fed raises rates, your monthly payments can go up, sometimes significantly. Imagine you have a $10,000 balance on a credit card with a 15% interest rate. If the Fed raises rates by 0.5%, your interest might jump to 15.5%, adding extra dollars every month to your bill. That might not sound like much, but over time, it adds up. And if you have multiple cards or loans, these increases can stretch your monthly budget tight. Take Lisa from Ohio. She had a variable rate loan for her car. After a recent Fed hike, her monthly payment increased by $75. That meant cutting back on groceries and skipping a few social outings. These rate hikes aren't just numbers. They affect real people's lives and spending choices. So it's crucial to understand which debts are affected and plan accordingly. Now let's dive into one of the biggest areas where Fed rate hikes hit home. Literally, the housing market. When interest rates rise, mortgage rates often follow. But there's a big difference between fixed rate and adjustable rate mortgages. With a fixed rate mortgage, your interest rate stays the same for the life of the loan. That means your payments are predictable and won't spike if the Fed raises rates. But with adjustable rate mortgages, or ARMs, your rate can change, sometimes annually or even monthly, based on what the Fed does. For example, a couple in Arizona, Mike and Sarah, plan to buy their first home with an ARM to get a lower initial rate. But after a series of Fed hikes, their payments jumped by hundreds of dollars a month, forcing them to rethink their budget and delay their purchase. Rising rates also slowed down home buying overall. Higher monthly payments mean fewer people qualify for loans, which cools demand and can slow down housing prices. For current homeowners, refinancing to a lower fixed rate becomes less attractive. So many are stuck with higher payments. So, understanding how mortgage rates move with the Fed is key to planning your home purchase or refinance wisely. Fed rate hikes don't just affect your loans. They ripple through the economy in ways that can change how you spend, save, and invest. When rates go up, borrowing becomes more expensive for businesses and consumers alike. That often leads to less spending. You might notice fewer sales at your favorite stores or less frequent dining out. On the flip side, higher rates mean banks often increase interest paid on savings accounts and certificates of deposit. Sound good, right? But if inflation is still high, your real returns might not grow much. For investors, rising rates can shake up the stock market, causing volatility. Bonds become more attractive as yields rise, which can pull money away from stocks. Let's look at Anna, a middle-class investor who had to rebalance her portfolio after a Fed rate hike. She moved some money from stocks to bonds to protect her savings. These changes affect everyone's financial choices, whether it's spending less, saving more, or adjusting investments to protect their future. So, what can you do to protect your wallet from the hidden impacts of Federal Reserve rate hikes? First, if you have variable rate debt like credit cards or adjustable mortgages, consider paying down balances as quickly as possible or refinancing to fixed rates if it makes sense. Building an emergency fund is crucial. It gives you a buffer when payments go up unexpectedly. Aim for at least 3 to 6 months of living expenses saved. Using budgeting apps can help you stay on top of your changing expenses. Apps like Inab, Mint, and Monarch offer tools to track variable costs and plan ahead. Lastly, don't hesitate to consult a financial advisor if you're unsure. A professional can help you navigate refinancing options, investment shifts, and long-term planning. Remember, understanding how these rate changes affect your money is the first step to making smart decisions. To wrap it up, Federal Reserve rate hikes have widespread and sometimes hidden impacts, from increasing your loan payments to influencing your spending, saving, and investing decisions. But knowledge is power. Understanding these changes helps you take control instead of feeling powerless. Whether it's paying down variable debt, building your emergency fund, or using the right budgeting tools, you have options. What matters most is taking action starting today. If this video helped you understand how rate hikes affect your wallet, please hit that like button. Subscribe to AI Cash Cortex for AI-powered money tips designed to help you thrive in today's economy. And drop a comment below. How have Fed rate hikes impacted your finances? I'd love to hear your story.